Hello friends, welcome to the special session. Many of you might be waiting eagerly, right? Because this is a 10-minute session, only 10 minutes. BFM 10 minutes, the toughest subject in your CIV. So I won't waste much time now. Like this video, share it with your friends, like this channel, subscribe to the channel, do all the things. Let's move fast, okay? Chalo. Today I'll be covering here. The topic for today is various types of risk in BFM. In 10 minutes, I'll be covering almost 8 to 10 risks, roughly. Very important ones. So, operational risk. Okay, I'll be fast in this because we have to cover all the risks. Operational risk. It is the prospect of loss of resulting from inadequate or failed procedures, systems or policies. Means, what is operational risk? Your own systems, they are not working. Employees do some error. Now, this is not only related to these policies. One more point is there. System failures, employee errors, frauds and other criminal activities. Now, one more important point which you have to remember is any event, floods, riots, strikes. Now, is this in the hands of your employees? Floods? No. But that is also the part of your operational risk. Okay? So, got this point everyone? Operational risk relates to a system any which ways in which the branch will be, branch will suffer. It won't be able to service the customers. Again, that is operations. So read this again. Okay. Exchange risk, also called as FX risk, forex risk, currency risk or exchange risk. So various names are there. Is the financial risk of an investment's value changing due to changes in the currency exchange rate? Changes in the, that's why I've underlined this, changes in the currency exchange rates. Immediately as the currency rate changes, dollar is, look at the rate for dollar today, where is it? Huge, gone up. Again, it's expected to go up or it can go down also in coming years. Hugely down. Okay, so exchange rates. This also refers to the risk an investor faces when he needs to close out a long or short position in the foreign currency at a loss due to an adverse movement in the exchange risk. Means basically dollar rate or the other currency rate may go up or down. And depending on that, you will face this exchange rate risk. Simple. Next. Credit risk. Credit risk means what? Credit risk is the failure of the counterparty. Now credit risk is of two types. Kindly note. You can read this. Credit risk is risk of default on a debt that may arise from the borrower failing to make required payments. Okay, required payments. In the first resort, the risk is that the lender includes lost principals and interest. Basically, what does it mean? It means that the failure of the borrower to repay the loans. Now, this is one counterparty risk, and second part of this risk is country risk. In country risk, what happens? The country itself is a problem. Like many countries are there, Afghanistan now, Bangladesh recently. Bangladesh is also same problem. So, the payment is not going out from these countries. Okay, so that is the problem. So, that is basically credit risk. Credit risk, remember, is of two types. One is counterparty, second is country. Okay. Premature settlement, pre-settlement, this risk that one party of a contract will fail to meet the terms of the contract and default before the contract settlement date. Pre-settlement risk, this is another type of risk, is a part of your credit risk only. Before the contract is maturing, that party says, I am bankrupt. So that is also a part of the credit risk only. Settlement risk. Settlement risk is the risk that one party will fail to deliver the terms of contract with another party at the time of settlement. So one party will fail. Suppose I give you dollars and you have to give me rupees. So you will fail to give me the rupees or I will fail to give you the dollars. One party will fail at the time of settlement. It's like buying the vegetables. You go in the vegetable shop and you buy vegetables, but you are not able to give the money. So that is settlement risk. It can be due to various reasons. Generally, settlement risk happens due to the time zone difference. Many times it happens because of that. You in your case only check this. Whenever you go to buy some vegetables, sometimes what happens that UPI is not working, PhonePe doesn't work. You take all the vegetables, everything you do. You go to the hotel, you do everything, and then the UPI is not working. So that is basically settlement risk. It is the control, it is beyond your control, but after all, it's a loss, isn't it? So settlement risk is the risk that one party will fail to deliver the terms of the contract with the other at the time of settlement. Settlement risk can be the risk associated with the default at the settlement at any time and any timing differences. See this timing differences. USA versus Bharat. Timing difference. Okay. Next. Liquidity risk. Liquidity risk is the potential for liabilities to drain from the bank at a faster rate than the assets. Liabilities drain faster means run on the bank. This concept is called as run on the bank. Run on the bank means what? All the depositors come to the branch for withdrawal. Run on the bank. So here you don't have money to support your assets. That is a liquidity risk. This mismatch in the maturity patterns of assets and liabilities gives rise to liquidity risk. Basically, what is liquidity risk? You are not able to pay your regular payments. That's liquidity risk. Gap risk or interest rate risk. This risk that the investment price will change from one level to another with no trading in between. Okay, interest rate risk. This is mainly interest rate risk. Gap risk is different a bit. We can combine many risks over here. This is basically interest rate risk. That the rate of the price of that quantity will change without trading only. Today market is closed and before the market opens, the price has changed. Why? Because interest rates have fallen. So that is interest rate risk. Gap risk means basically different. Gap risk is a part of your liquidity risk. Gap risk is a part of your liquidity risk. You are not able to get the payments, required payments from the assets to cover your deposits, means liabilities. That is gap risk. Gap risk is a part of your liquidity risk. And interest rate risk is basically this. Without any trading, due to interest rate differences, the prices of the bonds go down. So that is basically interest rate risk. Thus, if the purchase or and sale takes place from different value, a mismatch is created between the assets and liabilities, which is called a gap. Okay. Market risk, the possibility for an investor to experience losses due to factors that affect the overall performance of the financial markets. Now, importantly remember, market risk is not in your hands, not in your hands. Okay, means it's like tomorrow Russia-Ukraine war happens, it blows up, USA invades someone, then the oil prices will change immediately. It's not in your hands. But that will give rise to what? The interest rate changes. Interest rate changes means bond prices changes. Your asset value changes. So that is market risk. Kindly remember, market risk is never in your hands. Legal risk. It is a part of, this is a part of your ops risk, operational. Legal risk is a part of your operational risk. Arises due to non-enforceability of contract against the counterparty. Means you don't see the documents properly. This is legal risk. You don't see the conditions in that country. What all are the conditions in that country? You don't study. You just go on. Very risky. So that's a part of your operations risk. Systemic risk. A major risk fails. A major bank fails. It has domino effect. Domino means what? Ripple effect. Lehman Brothers. Look at this. 2008. Similarly, 2022. Right, we had Credit Suisse, okay, failure, okay. So systemic risk, a major bank fails and it has a domino effect. Other banks will also fail because they have purchased the bonds of this bank and these bonds will become zero. So that's why all the banks will face the crunch. So that is known as a systemic risk. Failure of one bank leads to the failure of many banks. Country risk means this, earlier I told you counterparty, this credit risk is a part of this. This credit risk has two parts, counterparty and country. So country risk is a part of credit risk. Counterparty is ready to pay, but unable to pay due to the government regulations. Afghanistan, North Korea, even Pakistan, Bangladesh. You sell to somebody, these guys are not able to pay. Why? Because the country has put the restrictions. So these are the major risks which I wanted to cover immediately. And in how many minutes? It is 10 minutes dot. Okay, so we'll stop now. And before going, join the batches, fresh batches coming up. Join this Mahapacks. Okay, you are getting double